Should you buy stocks or invest in property? This would be an awesome boxing match. In the red corner, we have Tyson Fury representing property investment. And in the blue corner, we have Anthony Joshua representing stocks and shares. Okay, there's not going to be a fight. There's going to be a discussion. Who is your money on? Property investing or stocks and shares? So let's cover the basics. Property investing involves purchasing real estate to generate rental income and benefit from the capital appreciation. The stock market, on the other hand, involves buying shares in companies, which can provide income, which is what we call dividends, and also stock price appreciation. The truth is, both have its merits and downsides. Historically, property and stocks have shown impressive returns across the board, and this is why they're both the most popular forms of investing for people that want to get more value. So let's start with some of the benefits of property investing. Property is a tangible asset, so it's a physical asset, which for the vast majority of people offers a sense of reassurance. You can feel it, you can touch it, you can live in the property should you want to. Number two, property investing, for the most part, when the tenants pay rent, of course, tends to offer a steady income. Now, according to the ONS, which is the Office of National Statistics, the average rental yield in the UK is about 3 to 5%, depending on the location. And one of the things that I love about property, which often gives the advantage over stock market investing, is this one key thing called leverage, meaning you can buy a property with a mortgage, meaning somebody else's funds, yes, the bank's funds, which means you can amplify your potential returns. Naturally, that also adds an extra element of risk. Now, many people might disagree, and I might disagree on this point as well, but there are some tax benefits. This would ultimately depend on how you've set up the business. Is it in your personal name or is it within a company structure? Now, of course, we've spoken about some of the benefits, but the reality is, in order to make a fair assessment on whether stocks or shares are better, we have to look at some of the negatives associated with property investing. So let's talk about this one straight away. Illiquidity. Real estate is not as liquid as stocks and shares. Illiquidity means how quickly can you get access to your cash. If you were to sell the property, it could take months to sell that property and also has heavy and significant transaction costs. If we're going to compare stocks and shares to property, we have to consider the high entry cost. Buying a property requires a significant amount of money. Yes, some of the gurus say you can buy property for free, but for the vast majority of people, it's going to require a significant investment. You're going to need a deposit, legal fees, stamp duty, and all of these costs can make this investment very unattractive if you don't have a lot of money. And number three, you've got to deal with the management. Now, you can outsource it, of course, to an estate agent or a management company, but the reality is you are still responsible for your tenants, which means it can cause property investing to be quite time consuming. And you've also got to factor in potential vacancies, which is what we call voids. And lastly, market risk. Yes, typically property prices over the long term tend to go up, but the reality is property can fluctuate due to economic conditions. Changes in interest rates, changing in the political atmosphere, things like lockdowns can also impact your investment in property. When investing in property, you have to consider the major startup costs. When buying an investment property, you typically need to put down at least a 25% deposit, and that's based on a property price. Right now, the average property price in the UK is around £288,000, which means you need to put down at least £72,000 to acquire the average property in the UK. It's a very cash intensive entry point. Then you've got to take into consideration transactional cost. Stamp duty on a £288,000 property is £10,540, and you need to budget for maintenance, management, estate agent fees, insurance, and according to Savills, typical maintenance and ongoing upkeep of your property can eat up between 1 to 2% of the property value annually. We've got to consider maybe the most important part, the legislation surrounding property investing. Legislation in the UK can heavily impact property investors. In recent years, more specifically recent months, we're seeing Labour and government introducing less favourable terms for landlords and more power and protection for tenants. Additionally, we have to take things like Section 24 of the Finance Act into consideration, which means changes to mortgage interest tax relief has made property investing via buy-to-let significantly less attractive. And also, staying compliant with regards to new legislation, new regulations, has a significant cost that has to be taken into consideration. So now let's look at the stock market in comparison. Stocks are highly liquid, which means you can sell them and get access to your cash with very low transaction and with speed. Number two, the barriers to entry are significantly lower when it comes down to stocks and shares. You can start investing in the stock market in some cases with less than £10. Yes, the returns are not going to be as great. Stocks and shares offer significantly more diversification than property does. When investing in the stock market, you can highly diversify by investing in different sectors and different industries, and over the long term, stocks have provided substantial returns. Now, of course, stocks and shares has its downside too, but I'm leaning more towards stocks as the downsides are not as devastating as property's downsides. But let's explore. The stock market can be significantly more volatile in the short term in comparison to property prices. News, market sentiment, economic data, geopolitical events can all affect stock prices within a very quick space of time. This is something a lot of people don't think about when making investments, and you should consider it. The emotional side of managing an investment. Because stocks and shares offer significantly more volatility than property, it can cause some emotional stress because your investment can go up and down at any given point. And without the emotional discipline, it can encourage you or cause you to sell those investments that would have possibly performed better over the long term. We've got to have a real conversation about dividends versus rental income. While some companies and some stocks pay dividends, not every single company does. So in comparison, you really benefit for the vast majority of stocks and share investments from the stock market price in comparison to property, where you get to benefit from capital growth, which is the house price increasing, but also a steady rental income. You only benefit from the steady dividend income if you're investing in dividend paying companies. Stock market investing offers significantly lower entry costs. You can open an investment account within minutes in many cases. You don't need much funds, you don't need much experience. And also transactional fees over the last few years have significantly reduced. And some platforms even offer commission-free trading. Also, maintenance costs for your stock portfolio is significantly lower than property. You don't need to worry about the upkeep. You don't need to worry about a leaky stock. You don't need to worry about having to fix the roof on Amazon, or you don't need to worry about your tenants not paying rent. The primary cost when talking about the stock market are just the transactional fees, whereas in property there are significantly more fees, compliance fees, management fees. When considering legislation in property versus legislation when it comes down to the stock market, it's not really comparable. The property investment side is hit with hundreds of legislations and policies, whereas stock market investing, we could probably count them on one hand. So of course, you've got to take into consideration capital gains tax, your dividend tax positions, but there isn't much regulatory changes or regulatory bother in stock market investing versus property. So let's consider what some experts are saying with regards to stock market investing or property investing. According to Savills, the UK property market is forecasted to increase over 18% over the next 5 years. And this is driven by supply and demand. The demand for property investing is what makes it a great investment, but also the supply side, the lack of properties available, cause it to be an incredible investment opportunity. On the other hand, while trying to find data on what I predict for the stock market, it's a lot more bleak. There is still an opportunity for long-term growth, as the stock market always offers long-term growth. But in the short term, due to upcoming elections in the United States, due to economic uncertainty, it's uncertain. However, analysts from Goldman Sachs predict that the FTSE 100 could see annual returns of around 5 to 7% over the next 10 years. But of course, that's going to depend on the upcoming elections, the winner of the upcoming elections, and of course, how those companies perform their corporate earnings. So is property investing better than the stock market? The answer is it really comes down to your investment preference. Are you looking for something that doesn't require much management? Then stocks and shares would be the way to go. Are you looking for something that's more robust and tangible and doesn't offer as much volatility based on market conditions? Then property is the way to go. We've got to take into consideration what your financial goals are, but more importantly, what is your risk tolerance? If you prefer a tangible product with rental income, then property is the right way for you. If you value liquidity, which means you need quicker access to your cash, lower entry costs, diversification, then the stock market is for you. Ultimately, any smart investor will tell you that both is the best option. Ultimately, a diversified portfolio is always the winner. Combining both property and stocks makes a powerful portfolio. So in this case, it seems like we might have a draw with Anthony Joshua and Tyson Fury.